afternoon, ladies and gentlemen, and welcome to a special edition of Unlock the Stock with Bell Equipment. Unlock the Stock is specifically formulated for retail investors to gain access to corporate management and to get to know them and their company a bit better. This event is proudly sponsored by Keyter, an insurance and FX service group. Keyter has made a significant footprint in their niche market, specifically bloodstock, sport horses, and game. Keyter has meticulously built the company into being South Africa's leading luxury lifestyle insurer and foreign exchange service provider. You can visit their website on www.keyter.co.za to meet the team and to read more about the services they offer. Our hosts today will be the Finance Ghost and Mark Tobin of Coffee Microcaps, and they will be facilitating the Q&A at the end of the presentation session of this event. We would like to welcome Bell Equipment, represented by the CEO, Leon Goosen. Before we commence, a couple of housekeeping rules. Bell will do a short presentation. Please note that you will only be able to post questions by typing them into the chat function, which is at the bottom of your screen. This event is being recorded and is available on the Keyter Rech Investor Solutions YouTube channel. So be sure to subscribe to that channel if you want to have a look at this recording and for future events. You will also see an email address a bit later that you can use if you want to be invited to future events. I'm now going to hand over to Leon Goosen. So Leon, if you could please share your screen and start the presentation. Thank you.
Fantastic, there we go. I hope you can see the screen. Can I just get confirmation, Vanessa?
All good, Leon. We can see and we can hear you. Thank you.
Great stuff. Well, thank you very much for the introduction. Good afternoon, everyone attending. What I'll do is I'll give a brief overview of the Bell Group. We'll then talk about the 2021 financial results. I'll talk about our plans going forward, and then we can deal with the Q&A section of this session. So, overview of the group. We're a leading OEM and distributor of a wide range of heavy equipment for construction, mining, quarrying, and the forestry industries globally. Currently, the ADT, or articulated dump truck, is our flagship product, designed and manufactured and exported to over 80 countries around the world. Our complete range of machines, ranging from a 20 to a 60-ton capacity, is optimized to deliver the lowest cost per ton through leading innovation and a focus on lowering operating costs, increasing productivity, and maximizing uptime. With the largest range in the market, we offer our global customers traditional 6x6 ADTs, along with a niche offering of a 4x4 ADT that offers cost advantages to customers not needing a 6x6 off-road capability. Our business model is clearly defined as a global OEM, a South African full-range material handling distributor, a cost-effective agricultural and forestry solutions provider, and finally, a provider of premium aftermarket support. We'll come back to our distribution strategy a bit later, but in the meantime, I can confirm quite excitingly that our OE strategy is to continue to expand our product range over the next few years, and this will assist us in achieving greater manufacturing efficiencies and enhance sustainability of the group. We manufacture and operate globally with our support network, which supplies equipment and after-sales services and support located strategically close to the main global markets. The independent dealer model has proven to be the most effective model in global markets outside of South Africa, mainly due to the wider product offering and shared resources of independent dealers. This ensures that our customers receive the level of service and support that they expect. Our global facilities comprise our main manufacturing facility in Richards Bay, KZN, our European manufacturing plant in Eisenach, Germany, and our South African sales and distribution head office in Jet Park, Johannesburg. This is also where our global logistics center is positioned, and furthermore, It is supported by our European Logistics Center in Alsfeld, Germany, which is the picture on the left, as well as our growing American Logistics Center in Charlotte, North Carolina, in the picture on the right. Our South African distribution and support is spearheaded from our Jet Park head office in Johannesburg, and it's supported by numerous branches throughout the country. As we own our distribution network in South Africa, there's been a dedicated focus on building the product range in this region to offer our customers a full range of equipment across all industries. This has largely been achieved through strategic partnerships with like-minded global OEMs. These partnerships enable us to meaningfully augment our own manufactured products, thereby providing a full spectrum of equipment for mining, quarrying, construction, roads, and rehabilitation, as well as government sectors. Our distribution strategy entails a consolidation of various product ranges and alliance partners to improve our ability to stock and support machines that are popular in the market. In this regard, we terminated some of the legacy product distribution arrangements we had, and during 2021, we successfully concluded the very exciting JCB product distribution arrangement for South Africa. So in addition to JCB, we continue to proudly represent Kobelco excavators and Finlay mobile crushers and screens, all global leaders in their respective fields. Furthermore, I'm also excited to let you know that we're going to enhance our forestry and agricultural offering in South Africa, and we plan to announce this exciting development at the NAMPO show scheduled for the middle of May this year. Now for an overview of the 2021 financial results. So we ended the 2021 financial year considerably stronger than the previous year in many respects. This was largely due to the commitment and resilience of our global team, which collectively put their full weight behind our strategy and focused on sales, efficiency improvements, working capital management, and cost containment initiatives. We experienced increased demand for our equipment in most markets. Investments in infrastructure and government stimulus packages benefited developed markets, particularly in the Northern Hemisphere, while improved prices and demand for commodities also resulted in some improvement in certain of the African markets. We bounced back from a loss in 2020 to a profit after tax of 294 million in 2021. As indicated, this was driven by an improvement in market conditions, especially in the Northern Hemisphere, and a strong recovery in sales, which were 20% up on 2020. Increased production volumes at both the South African and German factories resulted in higher recovery of cost, positively impacting on the bottom line. Effective management of working capital meant that a lower level of borrowings and a significant reduction in interest costs, and this, together with strong cost containment, contributed further to the improved financial performance. Headline earnings per share were at 294 cents compared to a headline loss per share of 31 cents in the prior year. In light of the improved financial results, a final dividend of 50 cents per share was declared. The OEM business in South Africa reported a modest operating profit of 8.6 million in 2021, an improvement on the 64.8 million loss reported in 2020. These results are sensitive to volumes, and the improvement was due to higher production and sales volumes and fewer once-off costs in 2021. Higher sales of complete machines to Australasia, our dealers, and higher sales of kits to Germany, to our German factory for Northern Hemisphere demand contributed to a higher recovery of overheads. External sales by our OEM business in Europe increased by 32%, with the contribution to total group sales increasing from 34.7% in 2020 to 38.4% in 2021. This segment was positively impacted by higher demand from the US, UK, and Europe in 2021. Much of this demand was driven by government-initiated infrastructure development programs, which are expected to continue and maintain high demand for capital equipment into 2022 as well as 2023. The Russian business is part of this segment and is a very small part of our group, with sales in this market contributing only 3.4% to the group sales. Since the developments in the Ukraine, the machines planned for the Russian market in 2022 have all been reallocated to customers in other markets. External revenue from direct sales operations in South Africa increased by just 2.3% compared to 2020, and the contribution to group sales reduced to 38% in 2021 compared with the 44.5% in 2020. The South African market, especially in construction and road building, remained weak during 2021, and the group did not see the same recovery in the local market as was evident in the Northern Hemisphere markets. The external sales of our direct sales operations in the rest of Africa, being our own customer service centers in Zambia and Zimbabwe, increased by 4.8% in 2021 and contributed 4.2% to the group sales. This segment did, however, report an operating profit for the year following the operating loss in 2020. So in closing and looking forward, momentum of our new products introduced is expected to continue. And given the increased demand for commodities, massive post-COVID-19 global stimulus and infrastructure spend, we do expect demand to continue to increase globally over the next few years. However, the industry outlook for South Africa remains depressed as the country grapples with low infrastructure spending in a weakened economy. But we are excited about the green shoots reported on by some of the remaining construction companies in the last few weeks. All regions reflect healthy order books for the remainder of the financial year, and our JCB distribution partnership is progressing well. And together with our excellent BEE rating, we do see a continued market share gain in South Africa. We'll continue to focus on cash preservation, working capital, and expense management in the current year. But most importantly, we'll continue to focus on executing our strategic priorities, new product development, and global growth objectives. We do believe there's a very good reason to invest in BEL, and we have quite an exciting future and global journey ahead of us, and we'd really like you to join us for this trip. But before I hand back the stage, allow me to convey special thanks to our extended family of customers and dealers across the globe who continue to invest in our product and ongoing support of their machines. I'm also grateful to all our stakeholders for their continued support and confidence in the group. Thank you very much, everyone.
Thank you very much, Leon. We're now going to go into the Q&A session, and as a reminder, you can post your questions in the chat box at the bottom of the screen. For this part of the event, the Finance Ghost and Mark Tobin will be the facilitators. So over to you guys.
Thank you, Vanessa, and thank you, Leon. That was incredibly interesting. Just from our side, a quick note around the sort of Q&A. So you're going to type your questions in the chat. And obviously here today we have Leon Goosen, he's the CEO of the business. So let's keep the questions focused on understanding more about BEL as a company. I think that's what everyone is here for today. I mean, everyone is well aware of, some of the difficulties and distractions that BEL faced in 2021, but let's separate that from the business, which is what we're here to learn about today. And especially after that 2021 result, it makes for really interesting reading. So Leon, I'll pose the first question if that's okay with you. I think the words that are on everyone's lips, one is commodities for sure, and the other is inflation. So, as commodity prices are increasing, there's more and more investment in this space. And I guess the market would imagine that that's positive for BEL. I think you mentioned it in your outlook, but maybe any specifics you can talk to around that would be really interesting. And then from an inflation perspective, which is the other big trend at the moment, BEL is a manufacturer. So the base assumption would be there's some good operating leverage in there, perhaps. But so maybe just some commentary on pricing power in this exciting time in the market as commodities are doing well.
Great stuff. Yeah, I think you're right. I mean, it is commodity driven, a significant portion of our demand, specifically here in the Southern Hemisphere. There's some great excitement, lots of mines opening up again. We've got inquiries from Central Africa, from Southern African countries, Southeast Asia, Australasia. So I think all in all, a strong commodity drive is very good for our business. A significant portion of our equipment is used in mining over and above construction. So yeah, definitely good for us, good for South Africa as well. In terms of inflation, yeah, we've seen a significant cost increase pressure from all over, from America, from Europe, raw materials, components we're getting from there in South Africa. And I think the difficult bit, and this is what we need to be quite mindful of is that with long-term contracts, we've committed to significant orders going into the future, and what we need to do is to ensure that some of these costs that are unavoidable is challenged, and then ultimately it would have to be passed on to our customers. We still need to protect our margins and long-term sustainability, but right now with the demand out there, it is quite an active market. So yeah, price realization is one of our key priorities for the current year.
We've got questions coming in thick and fast, Leon, from the audience. So I'm going to tackle a few of these. Maybe linked to the results. I think it was a 50-cent dividend was declared, and I'm not sure if it's actually been paid or not yet. But is that part of now a more formal dividend policy that you're thinking of, or is it going to be on a kind of results to results basis, given the variability? If we look at that kind of 3-year HEPS chart, you know, things are still quite up and down.
That's right, Mark. I guess we've spelled out the principles for a dividend in our integrated report all along, and we've always tried to stick within certain boundaries and certain rules, although none of them are hard and fast. But as you say, I mean, the business goes through cycles, and obviously the cycle that COVID got us into a couple of years ago meant that we had to go into a cash preservation state, and hence why we skipped a couple of dividends, but we're back on track in terms of a sustainable growing dividend over time.
Okay. And then another question on the kind of Russian market. Do you plan to exit there, or we saw the Barlow World guys saying we're kind of just going to hunker down and, you know, see what happens there? It's like too hard to even maybe exit at this point. Can you just give us a bit more color on your thinking around the Russian business operation at this point?
Sure, Mark. And I think you would have noticed from the update that I gave that it is quite a small portion of our business.
Mm-hmm.
We're certainly not as impacted as some of the other OEs or some of our other competitors. But very important, we've got people there, although they are all Russian citizens, they work for us. They're part of the Bell team. We've got customers there that requires our support. So we certainly have not made any call to abandon Russia and the customers that we've got there. But as you know, right now we are relatively prohibited from doing any business given the sanctions that's being imposed on Russia globally. So we obviously need to comply with all of those, which we do, which makes it hard for us. We've got customers phoning, requesting assistance, but to some extent our hands are tied a wee bit. We really hope for a quick resolve. We follow the news diligently, and we really hope that this whole unfortunate situation ends rather soon, so that we can get back to servicing our customers and looking after our people that's in country.
Leon, perhaps I can jump in there. A couple of questions just around cost of capital. A couple coming in on the CVR as well. We'll deal with that just now. So let's just jump into these cost of capital ones quickly. So I got a private question asking about the sort of reasonable long-term return on equity for the business. And then there was a public question from Carson around, cost of capital and historically perhaps some disappointment around returns on capital. So just some discussions around, where can that get to realistically? How is Bell thinking about, I suppose, generating what would be called economic profits, a return in excess of that cost of capital?
Sure. Yeah, I think to some extent it was a statement followed by a question. The reality is that you would have seen from the presentation, we have been on a journey to invest from a growth aspect to position ourselves stronger globally. It requires a lot of capital. Some of the capital is quite expensive. The South African portion, in particular from a borrowing perspective, shareholders' capital is expensive. But we did, in the last couple of years, disclose in the integrated report our outlook for return on invested capital. We did put hurdles there. It's connected to incentive plans, etc. And so far, we're sticking quite well to those hurdles and objectives. And we've got no reason to believe that we won't be able to meet those stated objectives.
There's a question as well around share buybacks, which is, kind of similar around capital allocation, etc. So to what extent would you consider share buybacks based on the debt being down to, manageable levels? And then people again highlighting, I suppose, the discount to NAV, which is something that often triggers a thought around, is it time for share buybacks?
Sure. So look, it is a standing agenda item that we consider on a regular basis, but I can confirm that right now our objectives for global growth, new product introduction, for scaling the business far outweighs the objectives of share buyback. So at this stage, our investment hunger for our growth aspirations is definitely trumping share buyback considerations.
Fantastic, thank you.
Leon, we got a question here. If you could expand on your plans for the product offering in the forestry and agri space, given the departure of John Deere. Will this be done organically through Matriarch, or are you looking at partnering with a different international OEM, maybe something similar to the JCB partnership?
Mark, it will be a combination. I think, again, picking up from the brief slide mentioning, we are looking at partnering with another OE for an enhanced product offering going forward. But there's also quite an exciting organic strategy that we're busy deploying, looking at our own products and own product development.
Another one then, if I can just ask one around FX, I don't think it was in your slide deck today, but it was in the results one where you've got that bar chart of profit and losses, and it does kind of even out over time, but we've got kind of particular rand strength at the minute. We often see bouts of like rand weakness. How should we kind of think as a rough rule of thumb? Is a strong rand good for Bell? Is a weak rand good for Bell? Just given how globally diverse it is, I'm just trying to think, is it dollar rand a kind of important cross from an overall profitability standpoint, or is it dollar pound, dollar euro, rand euro, rand dollar? I'm just trying to get a sense of what's the main cross, and whether strengthening rand, weakening rand, as you report in rands on a consolidated basis, just to kind of get a rough idea of like how it works.
Sure, Mark. If you had an option to tick all of the above, I would have chosen that one. But the reality is we are a net exporter, so we do appreciate a bit of a weaker rand. We do have a bit of a natural hedge in terms of also importing a considerable amount of goods into South Africa. But maybe at a macro level, a lot of our exports are US dollar based. A significant portion of our inputs are euro based. You'd have seen from the results that the UK has grown exponentially over the last couple of years. So all of a sudden, pound to euro strength or weakness is also something that we need to consider. So, and then some of the branded products, some of the alliance partner products that we bring in, they from the Far East, and then all of a sudden the yen becomes important. So hence why I said it's sort of like a bit of all of what you mentioned, but I'd focus on those core currencies being the euro, the dollar, the rand, and then to a lesser extent the pound and the yen.
Okay.
Just flicking down. Let's do the CVR question quickly. So I think that basically expires at the end of 2023, as I have it correctly. I don't know to what extent you're happy to chat on that, Leon, but there was a question from Carsten there around, is that CVR triggered upon the signing of a sale agreement or only the consummation of a sale? So there's obviously just a timing question there what triggers it? Because obviously there can be months between transactions, between actually agreeing to sell versus actually closing it. Is that something you can comment on?
It's not something I can comment on. I mean, it's not something that's where there's any new development. So that sounds like a fairly technical question. Maybe he needs to pose that to our company secretary, and then we can deal with it that way.
Yeah, that's fine. Carson, there's the advice for you on that to get some more details there to the extent that they can be shared. Just skimming through the list.
Can I just jump in with another one?
Mark,
here?
take one.
In terms of commodities, which if we look through the funnel to your end customers, are they more predominantly in iron ore or precious metals, or copper? I'm just trying to get a sense of for the because mining bit makes up, let's say, the bulk of the revenue, but within that complex of mining, what are the bulk of your customers involved in? So I saw iron ore prices spiked 5% overnight, so that's obviously a good day for the iron ore miners. So I'm just trying to if we take Bell as a kind of second derivative of where commodity prices are for your customers, what are they most involved in?
Thanks, Martin. It's almost like your question on Forex. It's like all of the above. But no, predominantly in South Africa, we're looking at coal, the PGMs, iron ore, as you mentioned, more towards Central Africa, north of South Africa. Copper is a massive driver, nickel, chrome. So gold in South Africa, it's sort of like all the precious and base metals. We've had great success in coal of late. I think understanding the South African situation with record coal export prices and demand from Eskom, coal was quite a big driver over the last couple of years. But of late, we've seen all the commodities driving demand, and not a single one all of a sudden stands out as to a abnormal driver of demand.
Leon, just around working capital, that's been a pressure that we're seeing coming through in the market across a whole bunch of companies. We're definitely seeing rising inventory balances. It's typical in a time of inflation, I guess, and also just supply chain challenges in general. The companies that can shore up their inventory seem to be doing so. There is a question there around why is the inventory figure so high? So I've guessed a bit there about what it might be, but to the extent you can just talk through that a bit more, like what is driving that higher inventory figure?
No problem. I guess the first statement is that we've seen quite a considerable reduction in the inventory levels over the last few years. You appreciate inventory as a function of the outlook and how we respond to that. Rightfully so, you do mention the supply chain considerations. It's a big risk currently. The supply chain globally is stretched. We see it with most of our suppliers. One of the things we respond, given that risk, is that we need to keep more buffers. We need to give a further outlook in terms of committing to orders and production schedules. So again, depending on how the markets then turn, if it turns down quicker than what we thought, like in the past, we'll end up with inventory that will be in excess. Fortunately, it's not perishable. We systematically consume it to bring it back in line with acceptable levels. And conversely, if we see a further acceleration of demand and the active market that we've seen in the last few months, we'll continue to work down inventory at a quicker rate than what inventory is arriving. If you do look at the inventory number and you analyze it a bit, you will see that there's quite a considerable amount of inventory in working progress, in components, in raw materials, etc. And the main reason for that is quite simple. It's us wanting to pursue the opportunities that's out there right now in terms of the elevated demand. Finished product is being worked down quite well. I also mentioned in the presentation that we've consolidated some of the products that we distribute in South Africa, and we disengaged from some of the previous alliances that we've got. And that also helps us to focus more on the higher volume product and reduce the spread of the investment that's required all throughout South Africa. And then also, as mentioned, the dealer model globally works quite well for us, where we are able to sort of hand over working capital sooner to dealers, as opposed to it's still being on our balance sheet in our own distribution network. I hope that answers the question.
I think I've got another one here, Leon. You know, we've started to see interest rates rising, and even though, you know, Bell's debt has come down a lot at that last result, I'm just wanted to get your thoughts on, you know, if rates are going to be rising, let's say, into the future, are you guys thinking about, you know, locking in some kind of cheaper debt now, or refinancing, or, you know, kind of what's the kind of thought process around, you know, having debt in a rising interest rate environment?
Sure, Mark. I mean, we've actually already started that process a good 6 to 9 months ago. We are looking at where we borrow in terms of currency exposure, in terms of the cost of the money, in terms of the tenure of the money. Yeah, I guess the short answer is that when your results are stressed, poor, like we were in the COVID years, it's not that easy to just go out there and restructure your whole borrowing profile. But with things looking better and the outlook looking better, hence why we've started a process, as I said, a good number of months ago, and we're about to start affecting those changes. I think when we get to mid-year, you'll have a much better picture as to how we've managed to restructure that, specifically with reducing the cost of these borrowings in mind.
Okay, great.
Thanks, Leon.
We'll there'll be more clarity on that when we get to the next half year result then.
100%.
But Karim has asked a question there, Leon, which is around just investing in global growth. You know, to what extent are you willing to talk about that? I think what's really interesting with Bell is it's a truly global company. A lot of people like to use that term, and it means they have, you know, 2 satellite offices somewhere else and occasionally sell something overseas. But that's definitely not the case with Bell. So I think to the extent you'd be willing to talk through some of that would be great.
Sure. Look, I mean, the reality is that as a global player, you need to invest to get recognized on the global playing field. We had to invest considerably in terms of infrastructure. I think if you analyze the last 4 or 5 years, you'll see building a factory in Germany, building a support center in Germany from an aftermarket perspective, implementing SAP there, putting up something in the US, a logistics center, following suit with investment in IT systems, SAP, etc. All of these things are quite capital intensive, but it's required for that global growth that we're pursuing. And then moreover, we've identified, and we've spoken about it many a times, that we can't just be a one product global player, which is the truck, which, although we do it very successfully, and we are able to compete against the global giants, we do need to have more product that can travel globally and that contribute to our sustainability. And that investment is not insignificant either. You invest a considerable amount of expenses in terms of research and development, and then growing those markets for the new products once you have launched them. Successfully, we've launched the track carrier now in the US. We're about to take it to Europe. We're busy understanding the markets there. And then I think when we get to half year, we would have done 2 things. We would have started explaining our strategies in terms of forestry and ag, and the products that we organically are looking at, as well as the products that we are looking at in terms of partnering with other people. But we'll also start talking about some of the construction equipment products that we've been investing in for a good number of years now, and that's quite exciting in terms of pursuing global growth going forward. So yeah, all of those investments quite necessary, and the returns are somewhere in the future once product validation and testing has occurred, and you're able to start moving volumes and scale those volumes into the markets that you penetrate. So yeah, definitely a long-term game, but definitely necessary in terms of effectively managing or rendering a return on the invested capital.
Yeah, I'm just talking about products. There was a question earlier from Richard as well, which is, this might be too much detail for you to be able to give, I'm not sure, but what percentage of your sales come from these ADTs, and how do the margins on those products compare to some of the other products in the range? So I guess a little bit of a mixed question there, and maybe how you see that developing over time.
Yeah, so the overwhelming majority of the global exports is the ADT. I mean, we've only literally started with the track carriers. Obviously, that's a completely different situation in South Africa, where we distribute a number of other products as well. So certainly, yeah, I think we can't just be reliant on the ADT going forward. And whereas that contributes currently the majority of the offshore revenue streams, in time that will change as we introduce the other products. The margins are acceptable. Being an integrated OE and distributor, we make sure that we manage it and that we understand it as such. We do need to make a sustainable OE margin to justify the investment in our future. And then obviously from a distribution perspective, dealers, distributors, owned or independent, also need to make a commensurate return with the support that they need to provide for the product, which is not a short-term product. The product has got a long life and needs to be looked after and supported for quite a number of years in operation.
Yeah, and perhaps something else on, on this sort of global theme, just supply chain localization. I think it's a theme again that we're seeing come through in lots of US companies at the moment. Every time I read an earnings result, everyone from Ford to all sorts is talking about this. How is Bell thinking about that? There was some press that got it a bit wrong lately around your thinking around Richards Bay. So maybe just highlight, just explain that once and for all in case anyone's caught the wrong message there. How is Bell thinking about that?
Yeah, thanks. It's actually a good point to elaborate on. Look, it comes down to flexibility and exposure to supply chains, global supply chains. Conventional thinking would tell you that the closer you do things to your customer or to your raw materials, the better, because the less exposed you are to fluctuations in global markets or unrest or shipping costs increasing like we've seen of late. So it's certainly something that we've started executing on, I guess, almost 2 decades ago when we put up a facility in Germany. The majority of our high value components emanate from Euroland, and sending it all the way down to South Africa for a round trip to be sent back into the UK, the US, the European markets, that's quite inefficient. Over and above costly, it impacts your flexibility. You sit with working capital for considerably longer than what you have to. So in terms of enhancing flexibility and responding to customers' requirements and needs, you've got to be closer to the end customer. Now, at this stage, more than 2/3, I'd actually go as far as to say more than 80% of the global ADT volumes are in the Northern Hemisphere. And us sitting in the Southern Hemisphere means that by design, there's a whole lot of inefficiencies embedded into our processes. So, and hence why 2 decades ago, we've started our investment in Germany to systematically do more or effectively get closer to the suppliers and our customers. Now, I think where we were misquoted, and thanks for bringing that up, is we're forced to do more in closer to the markets to eliminate the inefficiencies, to enhance flexibility, to reduce our investment in working capital. We're absolutely forced to do that to be sustainable and to respond to our customers' needs. Now, and that would mean that some of the stuff that we've predominantly done in Richards Bay over over the last few decades would have to be scaled down systematically and have to be scaled up in Germany. So, the verbiage used that we are moving, that's just wrong. We're already there. We're just increasing production on that side for things that we're already doing, and we're systematically reducing production on this side for things that we're currently doing here for the Northern Hemisphere. But the exciting bit here is that reduction is actually absolutely required for us to pursue all these new initiatives and new products that we're looking at, the new developments that we've invested in greatly. The factory is running at quite a high capacity to satisfy the demand for the Northern Hemisphere, and introducing new products and new exciting opportunities down in Richards Bay is not possible whilst there's no capacity. So this is actually, as I said, completely taken out of context, and I think that's to some extent what the press like to do, and as you say, posting political stuff or politicizing business strategic moves. Quite unfortunate. We've tried to, and we are setting the record straight that we're certainly not disinvesting from South Africa. It literally is one of the products that we're manufacturing that we're reducing to create capacity for new products, and that reduction would mean that we need to increase on the other side of the waters, closer to the market. So, definitely nothing sinister. Part of our growth strategy from a Richards Bay perspective. I think we've demonstrated over the last couple of years that there's certainly no objective to disinvest. We haven't let go of people. Thinking about it, COVID would have been an ideal reason to significantly reduce the workforce, which we didn't do. We strategically decided we need the people into the future to execute on our strategies, and we've kept the people. We're busy scoping a SAP implementation, which is it's a significant investment and effort that one needs to. Now, these are not things that one would do if you're busy disinvesting or trying to move. So, I think thanks for the opportunity to set that straight. It was definitely misquoted and misunderstood by some of the reporters.
Thanks, Leon. I think we're kind of pushing up on time here, so I think I'll hand back to Vanessa just to close out today's event, and thank Leon for his time and for all our guests and questions.
Thank you very much, Mark, and thanks to Finance Ghost, and also to Leon. And thanks to everyone else who participated on Unlock the Stock today. Special thank you for Leon for the time, because we know that's valuable. We hope that you've enjoyed this event. And if you're keen to listen to it again, it will be on the Keyter Rech Investor Solutions YouTube channel a bit later on. And as a reminder, the next Unlock the Stock event is on Thursday, the 14th of April at 12 o'clock, where Impact will be talking about closing the loop in terms of production innovation, and TWK, are you missing the wood from the trees? Thank you, everyone, and goodbye.
Thanks, everyone. Take care. Goodbye.
Thank you.